Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's just retired from his position as Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. But boy, you still keep an eye on those markets because, Victor, what could be more exciting?
Well, that's something I've been doing for 50-odd years, Jim, and I have no desire to retire. I actively trade my own accounts. I still get up at 4:30 or so, 5 o'clock in the morning, West Coast time. And, I make point of taking a couple of hours off in the afternoon, getting outside, playing golf or getting on my bicycle or something like that. But I'm back doing some more research in the evening and go to bed early so that I can wake up bright-eyed and bushy-tailed and take another crack at it in the morning.
Well, before we talk about individual markets, let's take a look at the big picture. In your weekly blog, you've been writing about the all-one market idea and a key turn date across assets at the beginning of September. What does that mean for our listeners?
Well, I think at least, let me talk it this way. I'm not going to tell anybody what they should do. I'll just say, here's what I do, and if you can learn something from it, fine. So what I do is I have to, just from habit, I guess, I have to have some idea of where I think we are. And let's say in a real simple sense, this year we had a couple of major events. You remember before the virus came along, the stocks were trading at all-time highs, the stock indices, I should say, trading at all-time highs in February. And then we had the virus hit. And the virus was one of those classic exogenous events where just out of nowhere, the market kind of went into panic mode. And probably the panic was exacerbated because we'd had kind of a parabolic kick to the February highs. But anyway, the market sold off very fast, got down to the March lows. And then we had the second major event of the year, which was this introduction of massive stimulus from central banks and governments at the bottom of the tumble in March. And from, say, late March until beginning of September, we've generally had these different stock indices going higher, commodities going higher, and the U.S. dollar going weaker. Now, and the market I'm leaving out there is the interest rate market. After the credit market sort of adjusted for having the interest rates driven to zero, the bond market has more or less, and some people could challenge me on that, but it's close enough for government work. The bond market's more or less gone sideways since April, so I'm going to leave that out of the discussion a lot. But over the years, I've noticed that sometimes you get a number of markets that change direction, reverse, on or about the same time. And I've coined this term a key turn date. And, I'm just a simple country boy. I kind of think it's significant if you have a number of different markets that all change direction on or about the same time. Much more important than if just one market does. So in my blog, I think it was the September 12th one in particular, I go into some detail pointing out, here's this market, here's this market, here's this market, and they all turned on or around that same day. Now, sort of one of the questions people have had in their minds is, gee whiz, we've had this incredible run in the stock market, particularly in some of the high-tech stocks, and of course, just bizarre increases in some of the things like Tesla and perhaps even Apple, where they've had this incredible run off the March lows. And the question's kind of been, is this ever going to end? And if it ends, what will it look like and all that sort of thing? So again, the big picture. We had that amazing run. In my view, it was kind of capped off They had the TINA. There is no alternative. The fear of missing out, the reward for being, reaching for yield, momentum, the outperformance of this, that, and the other thing. And then as we got near the end, it was sort of defining to me, in my mind, the top. It seemed as though this, what we call the retail army, folks at home in their pajamas trading on the screen with zero commissions, were just going crazy with buying out of the money call options, which on the floor, the pros call those things lottery tickets, because your chances of making any money are about the same as, a lottery ticket. But if you win the lottery, it pays off huge. So hence, people go crazy for it. And then that one final thing, which was Apple and Tesla both announced they were going to split their shares. And there was the same retail crowd was buying call options on Apple and Tesla in particular, buying the stock as well, pushing the dealers who were selling them the options to have to buy the stock. And it was just like no surprise to me that the market topped out within a day or two of the split shares beginning to trade. And for both Apple and Tesla, that was August 31st. And the key turn date was around the 1st or 2nd or 3rd of September. That was with the stocks. The U.S. dollar was just the flip side of that. The U.S. dollar had been trading lower, and certainly since the Fed drove U.S. interest rates right down to the floor or below in terms of real interest rates, the interest rate advantage that the U.S. dollar had over a number of other currencies was gone, and the U.S. dollar was trending lower. Now, we looked at this particularly against the euro. The euro-U.S. dollar is the key cross rate in the whole FX trading world. And we saw the positioning of speculators in the futures markets go from very bearish on the U.S. dollar around the time of the panic lows we had in March to a record all-time bullish position in just 4 months. So it's this huge swing from bearish to bullish on the euro as the euro rallied and I think pulled other currencies higher with it against the U.S. dollar. And just like the stock market, we had this momentum that came into the euro. Honestly, also came into gold, which was tied with the weaker U.S. dollar and so on. We had this parabolic kick, I'm going to call it, late in August. And I've quoted Bob Farrell to you many times before. The public, one of his rules, the public buys the most at the top. When the silly summer season, as I called it, came to an end around the beginning of September, we had this very sharp turn across different equity markets, across commodity markets, and certainly also in the U.S. dollar market. So U.S. dollar has been rising, stocks have been falling, commodities have been a little softer since around the beginning of September. I think that's kind of the backdrop as to where we are here in terms of the big picture.
You often refer to market psychology and price action. Does that mean you make your trading decisions just by looking at the charts of different markets?
No. I would not do anything. And by the way, I trade specifically futures and options. If you're going to try to be good at something, and I'm trading my own money, so I'm not just experimenting. I want to do what I think. I want to trade in markets where I think I have some idea of what I'm doing, okay? And you cannot be good at everything, so I've chose to just stay focused there. I don't trade individual stocks hardly at all. I don't trade ETFs. I don't trade baskets, different constructions. If I'm going to trade stocks, I'll trade the different stock indices. But I will not just look at charts, but I won't make a trade without looking at the charts. That's very important to me. I pay attention to, I read a lot of different analysts, for instance. I particularly pay attention to people who got a different view of the world than I have. Kind of thing, it challenges my own view. And, as my friend Dennis Gartman used to say years ago, you want to trade like a mercenary. In other words, be on the winning side. You don't get any merit points, for hanging in there, holding on to a losing trade, taking one for the team and all that sort of stuff. The market's going down. Either get out of your long position or be short. Don't be a hero, right? In terms of looking at the charts, ever since I started trading in the commodity markets in the mid-'70s, would sit in front of our desk, on our desk with charts in front of us, looking at screens and all that sort of thing. It's just a habit. But the way I've kind of come to see it is, I know that the markets that I trade, if I'm going to trade the euro market, I'm going to trade copper, gold, what have you, that there are literally millions and millions of people all over the world that are trading those same markets. I have no idea who they are, what they know, what their time frame is, how much money they've got at risk, what motivates them. And in particular, I certainly don't know what they know. So I believe that these folks that are out there who will move markets, I am totally inconsequential to the market in terms of the size that I have. But what those folks do, or maybe what they do will show up in the market, and what in particularly I'm looking for when I look at the charts is, if the charts get to such and such a point, what might those folks do then? So that's a lot of what trading is for me, is to, instead of saying, this market's goofy, overvalued, I'm going to sell it. That's a dumb idea. I will not do that. But if I can see that a market's had a run to the upside, has failed, and has come back again on kind of a buy the dip, but that starts to fail, now I've got a chart pattern that I'm much more comfortable shorting. So definitely I'm going to look at charts, but I don't do that exclusively. I want to do whatever I can to give myself that much more of an edge to making profits with my trading.
The stock market's made up of thousands of individual stocks and thousands of ETFs, and everybody knows that the big tech stocks like Apple, Microsoft, and Amazon have hugely outperformed the broader market. So when you trade the stock market, how do you adjust for that when you just have a few big boys with such big influence?
What I trade in the futures and options market are different stock baskets. For instance, there's a futures market on the S&P 500, on the Dow Jones Industrials, on the NASDAQ 100, on the Russell. And then there's different ones on different, like there's futures markets in the Toronto Stock Exchange. There's futures markets on the Japanese indices, German indices, and so on. So I will trade those indices. I definitely will pay attention to markets that I don't trade. For instance, I've been noticing lately there's been a lot of talk about rotation. Value has been so weak relative to growth. Maybe there'd be rotation from the high-flying growth stocks to the laggard value stocks. I'll pay attention to a lot of that stuff. I'll pay attention to what different credit markets are doing. For instance, corporate debt, which I can't trade in my markets as a futures contract, but that can give me some sense as to what may be going on in the equity market. For instance, here with the NASDAQ, which has been the strongest of the major indices because it's so heavily weighted in tech, and the big tech stocks are all in there, it's, flowing to the upside the fastest and the strongest. But it's also, since the beginning of September, corrected the most. It's down, let's say, 14% or thereabouts. Unbeknownst to a lot of folks, the Dow Jones Transports actually was making new all-time highs last week. So that's kind of a rotation. I'll pay attention to that. But the things that I trade are these indices that are futures markets. So that's how I deal with the stock market. It's not a monolithic thing. The stock market is, it's an amalgam of all kinds of things, and you want to pick your spots.
We'll have more with Victor Adair right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome back. We're speaking with Victor Adair. Victor, gold was one of the best performing assets from the March lows until early August, but since then it's lost about $200. What are your thoughts on the precious metal?
Let me preface this by saying that I've traded gold for 50 years. I was partners with a couple of guys. We were selling, I should say, physical gold and silver in the mid-1970s, around 1974, I think we started doing that. So I've been around the gold market a long time. It's a great market. I am very aware of the reasons, why you should buy gold and all that sort of thing. And it could well be that 2 years from now, gold might be, I don't know, $3,000-$5,000. I don't know. I'm not saying it will be. That's possible. Doesn't matter to me right now. What I'm looking at from a trading perspective, for me, that's a time window usually of a few days to a few weeks. Okay, that's sort of my sweet spot. I think the most dominant thing in the gold market this year has been the gold ETF market. Two numbers. One is that the amount of gold, this is the global ETF market, but by far and away, the American gold ETF market is the most important of anything else, or almost all the rest of them put together. The total size right now is about $240 billion. There has been $100 billion come into the gold ETF market this year. In other words, about over 40% of the total size has come on board since the beginning of this year. What that means to me is relatively, I think also that ETF buyers are maybe a little more patient than futures buyers. Okay, they may have sort of got the gold bug story and believe it, and will stay with the position, probably not as levered as people in the futures market. So they're not going to throw the baby out with the bathwater in a real hurry. But I think similarly to the run-up in the stock market since March, there has been what I would call hot money come into the gold market. And I've been writing for the past few weeks on my blog that I thought the gold market was vulnerable to having a sell-off. And, we're down $45 or so right today as I'm talking, as it's broken below its trend line. It's broken below the 50-day moving average. And I think it's moving in correlation with the stock market. So that's been the most important thing in gold. Another thing I've noticed is that the gold stocks seem to not do as well as I would have thought, given how strong gold was as we went into the early part of August. And by the stocks, I don't mean the junior stocks. I mean the majors, the Barracks of the world, Newmonts, that sort of thing, the major Franco-Nevada royalty trusts and so on. They just didn't do as well. Now, obviously, I'll also pay attention to silver, pay attention to the gold-silver ratio, and, silver's been particularly hard hit here the past couple of weeks, even harder than gold. I think there's a risk of gold going lower here yet. I mean, we're down $200+ from the August highs. That's, roughly a 10% decline from the $2,000 or so level where we got to the beginning of August, 2050, I guess. I think gold can be a little weaker yet, especially if the U.S. dollar is a little stronger. Now, this is because we're looking at the price of gold in U.S. dollars. The past couple of years, the U.S. dollar hasn't been as important to the gold price as it usually is, like it's an inverse relationship. What has been important has been the gold relationship with real interest rates. The past, let's say since the beginning of August here, that seems to have, the real interest rate impact on gold prices waned, and I think the gold right in the very short term here is paying much more attention to what the U.S. dollar is doing, and there's also this positioning risk with all this money that's come into gold basically since the March lows, that might look for an exit. Even if, let's say, people have bought gold with some of the profits they had in the stock market, if the stock market's weakening on them, they may sell their gold to try to maintain their stock position. So all that stuff, but I think it's at risk of a little more downward price action.
The U.S. dollar hit multi-year highs during the March panic, then fell about 10% at the beginning of September. It's bounced back a bit. What's your outlook for the U.S. dollar?
Well, as mentioned here a couple of times, there has been a strong correlation between the U.S. dollar and stocks. And what that has been is as the stock market was stronger, the U.S. dollar was weaker since March. Okay, that may or may not continue. Now, here's one of those little ironies in the world of trading. And it seems to me that once you identify a correlation, what I call an if-then trade, if something goes up, then the other thing will go down. You identify these correlations, then bang, they change, or they evaporate. But if the market now, for some reason, gets emotional, and it would probably get more emotional if we were to have a sharp fall here over the next couple of weeks, month or so, heading up to the American election, for instance. If the market gets more emotional, I think the correlation between the dollar and the stock market will get stronger. So if the stock market does weaken here over the next few weeks, I'd expect the U.S. dollar to rise. Now, for instance, in particular, the gold salesmen of the world will tell you that, the U.S. dollar, like all other paper currencies, blah, 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 all that argument. That, believe me, I know there is a lot wrong with the U.S. dollar. Interest rates are virtually zero. Trade, current account deficits are a real problem. God knows there's political problems down there. But in the world of currency trading, it is a beauty contest, and it's usually the prize goes to the least ugly. Okay? If you think the euro is the land of milk and honey, I tell you, you want to take a look at the share price of the, let's say, an index of European banks over the last few years. As those folks over there have pushed interest rates and maintained interest rates down around zero, they have clobbered their banking sector. So, money may flow into the euro as it has, but I think the U.S. dollar might be a case of, this is talk, like the last man standing. You want to be careful if the market gets afraid. You want to be careful of being short the U.S. dollar.
If currency's a beauty contest, does the Canuck buck have a chance at being at least Miss Congeniality here? Because it's swung between 68 cents and 77 cents. If the U.S. dollar is stronger, does that automatically mean the Canadian dollar plummets?
Well, we've talked about the Canadian dollar, and forgive me for being a broken record, but the main contributors to the value of the Canadian dollar are the relative strength and weakness of the U.S. dollar, how the commodity market's doing, and lately, Canadian dollar has had a pretty good correlation with the S&P. Well, no kidding, because these correlations almost become incestuous after a while. Yeah, Canada hit a 4-year low at around 68 cents when the panic was at its maximum around the end of March this year, and rallied all the way back to 77 cents. But then virtually every currency in the world, and let's leave the Turkish lira on the sideline, but a lot of the major currencies, Australian dollar, British pound, euro, Swiss franc, Japanese yen, were rallying against the U.S. dollar, just like the Canada. Some of the currency traders, like my good friend Jack Crooks, refer to all the other currencies as the pack. So the Canadian dollar, I was surprised, honestly, that it got as high as 77 cents. And I've been, over the past 10 years or so, inclined to short the Canadian dollar, way more than inclined to buy it at any point in time. So I've got a pretty strong bias about Canada relative to the U.S. dollar. But around the 70-odd cent area, I could be kind of neutral on that and just look at what's going on. I've been on the short side of Canada as I've been on the short side of Mexico. When I say Canada, I mean the Canadian dollar, the Mexican peso, the euro currency. What else in the currencies? Gold. I've been shorting here certainly the past couple of weeks, as I've been also short the stock market and eventually long the U.S. dollar.
We'll have more with Victor Adair right after the break.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Victor, in your recent blogs, you pointed out that both copper and soybeans traded to 2-year highs recently. Has the big bull market in commodities started?
I don't know, but my gut instinct would say probably not. And the probably not is I think we're struggling in a deflationary environment here, and that's not good for commodities. Now, the copper market in particular, we hit a 4-year low in March. That was after a brutal 5-year bear market. So we've had a pretty snappy run here to the upside, although looking at my screen here, I see we're down over 10 cents today from these 2-year highs that we reached last week. On copper, why have we rallied? One of the stories, and you just don't know how true this is, so I say stories. But one of the stories has been Chinese buying. It seems as though the Chinese economy is doing better than you might have thought otherwise. It seems, as though they don't have a virus problem anymore. And we just for the sake of clarity, we all know you put seems in parentheses there because who knows, But I think a part of the copper buying by speculators has been embracing, the electric car story and how much incredible demand there will be for copper as the world goes electric and so on and so on. Yeah, I get it. That may or may not come to pass. We've had quite a run. Soybeans, by the way, also rallying from very depressed levels. The grain markets in the States have been just like skidding along the bottom or the lows of the past number of years for some time. Part of the story on that is, the Chinese buying soybeans as part of the honoring the trade commitments they made with the United States and rebuilding their hog herd. I'm not going to go any further than that, or I don't want to sound like I know what I'm talking about with soybeans. Just the stories I see. Your question was, is this the beginning of the big bull market in commodities? I'm thinking no, because of these deflationary pressures. Deflationary pressures to me just means lack of real demand, and the people that produce this stuff just got to keep cranking it out there, so supply overwhelms. They got to keep producing it because they need the money. And when you have that kind of an environment, the supply overwhelms the demand side and prices fall. So I'm more inclined to think that copper here above $2, I should say $3, a pound is, I tell you what, if I wasn't already committed on the short side in currencies and stocks and long the U.S. dollar, I would probably be trying to get short of copper. But one of the things I need to be very careful about with my trading, especially in this sort of all-one market environment, is what we call concentration. In other words, I've already got the trade on, and if I want to go and short copper as well, then I'm just doing more of what I've already got, and I may be pressing my risk limits a bit.
WTI crude oil was at a near 6-month high, around $43 at the beginning of September, fell $7 in a few days, bounced back about $5, but then lower. Does crude fit into the all one market basket? And do you think West Texas crude is going lower?
Short answer would be yes. My son Drew and I, and I'm going to give full credit to Drew on this. He proposed this idea back in July that instead of just going out and being short crude, because we both saw crude as what I call a lack of demand story. You know, the producers again are just have to crank the stuff out, and the world is not demanding all of that supply, so, you know, we adjust with lower prices. But instead of just being short crude, we put on what we call time spreads, where we bought deferred contracts and sold the nearby, looking for the relationship between those different delivery periods to work in our favor. And that turned out to be a great trade. We made some good money on that, got out of it as that reversed when prices started to rally, I guess, the beginning of last week. And now we're back on the short side of crude again, this time using some option strategies. When I look at crude and how weak it's been, and, you know, to some degree the crude had to pay attention to the U.S. dollar, and with the U.S. dollar down, crude prices, as measured in U.S. dollars, should go up. The crude market, I think, was also taking some strength from the stock market. But really, the rally for crude, and it made its low in April when prices went negative, you know, a month later than the March low for the stock market. Crude really didn't get pulled higher in a big way by the strength in the stock market, and the crude also had a turn down around that key turn date right at the beginning of September. I think the bigger risk in crude, no, this is bar some, you know, nasty geopolitical event which could spike the price of crude. But leave that aside because you can't predict those things. I think in terms of supply-demand imbalance, I think that the risk is crude goes lower. Or in other words, that's the bigger risk.
You actively trade your own money in the futures and options market. You've been doing it for over 40 years. What's your philosophy overall?
Well, something that thought just popped through my mind when I was saying that about crude. And, you know, the thing that popped into my mind was, if something is obvious, it's obviously wrong. Okay? I mean, if something just looks the old thing, if it's too good to be true, it is. You know? I definitely have biases on different markets. People listening today can hear that I've got kind of a bearish bias on the stock market, but I pick my spots. You know, going through August as the stock market, the different indices were sort of chugging higher every day. But I'm not going to say I didn't short, because I a couple of times got a hunch, bet a bunch kind of ideas of this is just goofy. But I'd always sell just a little, just a very little, and I'd be gone quickly if the market carried on rallying. But one of the things, and we talked earlier about, you know, you pay attention to the news and how markets react to the news, but I really, really look at the charts, and I gave you some reasons as to why. One of my favorite kind of chart patterns, when you have had a market that's had a parabolic run to the upside, as we had in the major equities, has a break. I love to see it have a bounce, you know, rally back, but fail to make a new high and then roll over. Now I'm much more confident to put on a trade than if a market's just running to the upside. I mean, if market's just running to the upside, you know, and I'm selling it because I think it can't go any higher, honestly, that's a dumb trade. But I'm just much more comfortable to put on a short position in a market where it's had that crack, rally back on the buy the dip buying because people have been trained, you know, anytime it falls back, jump on it, and then just can't make a new high and rolls over. To me, that's a layup in terms of putting a position on. When I say pick my spots, I really, really believe that how I manage the risk of the trading that I do is way more important than trying to find the trade in the first place, or, you know, having the crystal ball that gives me a real good idea. And when I say find a trade, I have to find a spot where I can put on a position where I like the risk-reward ratio as I see it. for me, one of the toughest things to do is if I'm bearish on the stock market or bearish on across the board here, like gold is down 45 or so bucks today, and I'm not short gold. It would be really tough for me to step in and short gold here. I'd be, in my mind, selling it in a hole. And even though I'd remain bearish on gold, gold could rally 50 bucks before, without really disturbing the downtrend. So I've got to pick my spots. I don't want to chase a market. And I have, believe me, but when I find myself chasing a market, like the thing's getting away, I got to get a position on, I'm almost always put a trade on in the wrong spot. So I got to remind myself that, the markets will be open again next week. I got to remind myself it's not a game of perfect. I was short some Mexican pesos this morning. I had a good profit in the trade, saw something in the market. I took the trade off, and then the peso continued to fall. And go, I should have just stayed with that. It's not a game of perfect. You get to miss, way more trades than you catch, and a lot of the ones that you catch, you're going to wish you hadn't got into them in the first place. So I focus on what I call trying to make good trades, putting them on in a good position, and if the market doesn't give me that opportunity, I just don't make a trade in that market. And I'll leave you with this, and a good friend of mine, Peter Brandt, who's been at this for a long, long time, and has written a book, Thoughts of a Professional Commodity Trader or something like that. Peter pointed out that in his 45 years of trading, all of the profits that he has made came from about 15% of the trades that he made. The other 85% of the trades just kind of washed each other out. He might well not even put them on, but you never know ahead of time. And the other thing that I thought was this part of the 80-20 rule as well was that when he looked back at his monthly P&L, he saw that only on less than 20% of the months, the monthly periods going back over a 40-plus year period, did he make any money. So you have these periods of time where you can't do anything right. The best thing you can do is to sort of keep your nose above water, because you're going to have a bias, you're going to have something, or it's just going to be, call it bad luck, that you get dealt the wrong cards. You just can't make any money. But you have to kind of maintain your sanity and maintain your capital for when things come around to where you can capitalize, and you really got to step up and put your money where your mouth is.
Victor, thank you so much for chatting with us.
Jimmy, you get me kind of wound up. I love talking about trading, and I truly, maybe one last thought just occurred to me. You never want to hope that somebody else loses. And I think that's really important. Your grandmother might say to you, if you don't have something good to say about somebody, don't say anything at all. That's good advice. And I think in trading, you don't want to hope that somebody else gets clobbered and like you can take advantage. Or I think that's dangerous. You just want to say, hey, I got what I got, and I've got to be happy with that. I surely could have done better, but it's not a game of perfect. But you don't want to wish that somebody else does bad so that you can do well.
I've been speaking with Victor Adair, co-founder of the Polar Futures Group. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com, our YouTube channel, Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.